Hi everybody, Lance from ThetaTraders.com here. In this video, we're going to go over the VIX, the considerations on when you sell options, when the VIX changes, and some mitigation techniques when VIX expands and you're using up a little bit too much of your buying power, possibly in futures. So let's get right to it. All right, so I'm going to review this blog post that I wrote yesterday. Link is in the description down below if you want to read through it. So recently the VIX in the beginning of the week went from a low of around 14 to a high of 1724. Pretty dramatic increase in a week. And then it's now in the mid high 16s at close on Friday. So at thetatraders.com, we do sell premium in different VIX environments, and we look at different situations where you might want to sell additional premium. In general, you want to sell additional premium when the VIX is high, and then possibly sell a little less when the VIX is low. So VIX has to do with volatility, and it's the fear gauge. When the VIX is really high or expands, it shows an increase in uncertainty and volatility. We actually want to take advantage of this uncertainty with the volatility because typically it's over exaggerated, and a lot of times the VIX will decrease over time once you have an expansion. Now, we're not at a huge expansion when it hits 17, but it still could possibly drop very quickly. So diving into the impact, VIX again is a fear index. When your VIX is low, there's low market volatility and complacency, while high VIX is a heightened uncertainty. So if you look at this chart here, this is the S&P 500 in 2022. Saw a lot of big drops and then started to recover. This little cone you see goes into the future from this chart, and this is essentially the expected move where it's a possible range of values with a high probability of getting somewhere in this range. Notice as you go further out in time, the cone widens because obviously there's more time for it to move in a certain direction. When the VIX is very high, this cone is very, very wide. When the VIX is low, the cone will be relatively smaller. So when the cone is very small, you're typically not going to get a lot of option premium because it's pretty expected where the price will be. But when the expected move is very wide, there's a much better chance that you can take in more premium because there is more uncertainty, the width of the cone. So the market might go over here, might go over here, here, here. But again, if the VIX was much smaller, it's going to be somewhere in this range over here where my mouse is. So the impact on your margin premiums, when the VIX expands, the option premiums tend to increase because of that increased uncertainty. And then sellers of options, this usually can be advantageous because when you sell an option, you receive the premium from the buyer. When the VIX is higher, in general, you might want to have additional funds available so you could be selling option premium because you're taking in more premium at that time. When the VIX is a lot lower, you might want to consider using a little less of your funds, leave a little bit extra excess cash so you can take advantage when the VIX does increase, and then you could add in some more positions. It does come with increased risk, though, because of that cone of uncertainty is a lot wider, and you could possibly go deep in the money if you're not aware of what you're doing. So remember, as a seller, you have the obligation to buy or sell the underlying asset at that strike price if the buyer chooses to exercise. We do futures options with MES, ES, different commodities. Luckily, those you'll not get early assigned on, but for individual stocks, you do have to be aware of that. Some considerations for choosing in high VIX environments: choose your strikes wisely. You want to look at technical indicators, support resistance levels, MACD, RSI, other indicators to determine relatively safer strikes. Diversify your positions. This is good in general. So you don't want to put all your eggs in one basket. At thetatraders.com, we do a lot of different commodities like oil, gold, soybeans, also the S&P 500. There are different hedging strategies. Buying protective options like puts, especially with futures, is a very simple way that you could hedge for your portfolio. One of the easiest ways to do this is to go really, really deep out of the money and buy the put, not sell the put, just as a hedge. Now, you don't want to do that for a huge amount of your account, and it will lower your possible returns if the market doesn't completely drop. However, it could help out your buying power because you have that protective put in place if the market does drop. that option would be worth a lot more. So historically, when the VIX is in the mid-teens, we've done very well selling options. Typically, when the VIX is at 16, 17, we're doing really well in the zero DTE options. Currently, we have 14 winning trades in a row in the zero DTE. And when the VIX is a lot lower, there's a good chance we could stop out because the small moves will get us at the 3x stop. However, when the VIX is higher, we can take advantage of those smaller moves and not necessarily stop out on it. So now would be an excellent opportunity to be selling a little bit additional option premium, especially if you have some cash on the side. There's a good chance the VIX might stay where it is or drop a little bit. You should also leave a little bit of extra cash in case the VIX goes much higher to the 20s or whatnot. There's a chance that could happen. So you want to have the strategies in place to take advantage of those opportunities. So if you have any questions on that, you could join a free 7-day trial at thetatraders.com. There's a link in the description down below. I have a one-on-one Discord. You could ask me any questions. Have plenty of strategy guides on all these different environments. Again, thanks for watching. Like, share, subscribe, all that good stuff. Helps out the channel. Appreciate all your support, and have a good rest of the weekend.